Welcome to FM with Sir Evans. In today's session, we will discuss the 7th competency in the syllabus of ICA Paper 2.4, Financial Management. Let's get started. So we are looking at the nature and purpose of business valuation. Business valuation is the calculation of a value for the shares of a company or the value of an entire company. That's the equity plus the debt. For quoted companies, they already have a share price valuation, which is the current market price of the shares. However, the main reason for making a business valuation is when there is a takeover bid, the bidders will offer more for the shares in the target company than their current market price. The bidder would then need to make a valuation to establish a fair price or maximum price that he will bid. This value can vary substantially depending on the plans that the bidder has for the target company after the takeover is completed. For unquoted companies, some reasons for the valuation are: we are looking at the convention to public limited company to launch on the stock market, when shares are sold privately, when there is a measure to decide the terms of the measure, and when shareholder dies and valuation is needed to establish the tax liability on his estate. So there are a number of models of valuation we'll be looking at. These are all based on estimates and assumptions. So some of the approaches include, we have the asset-based valuation, which is based on asset value of the target company, the market-based valuation, which uses estimates of future earnings or dividends. And we have the cash flow-based valuation, which uses discounted cash flow or expected future returns or expected value added. All the methods have a rational basis, meaning there is a logic to the valuation, and it is obtained through objective analysis and assessment. The results decide on or justify an offer price, and final price is agreed through a negotiation. The only correct valuation is the price that the bidder makes and the shareholders in the target company eventually accepts. So the net asset value or the balance sheet basis is one of the methods of the asset-based valuation models, which we'll be looking at. Now, all these models use the net tangible assets of a business as a valuation. So we go into the net asset value. So this uses the book values for assets and liabilities readily available from the account ledger of the company. So some intangible assets such as internal goodwill and value of company's human capital are ignored. This produces a minimum valuation, which might be based on book value of his assets. Minimum equity would be the book asset minus the liabilities. Assets revalued regularly might be sufficient for an asset-based valuation without the need for further adjustments. Where this method is used as a net asset value, some adjustments must be made on certain assets perceived as too high or too low. We look at the net asset value or net realization value. So this is a net asset valued according to the disposal value of the asset. This is the amount that could be obtained in the event of liquidating the company and the assets being sold off. Net disposal or breakup value is usually irrelevant unless asset value as a going concern is higher than the breakup value. A very approximate estimate must be made to estimate the disposal value of the target company's asset. This method is used when assets of the company are valuable and their current disposal value might be worth more than the expected future dividends or earnings than the company will provide from using the asset. There must also be the intention to liquidate and sell the assets. Then we look at the replacement value. This measures the value of net assets at their cost of acquisition on the open market. Intangible assets will be excluded, so it may undervalue the company. It may be very difficult to identify and value individual assets and liabilities. So generally, the value of business comes from the expected returns it will generate, not the reported asset values. So we move on to income-based valuation methods. The first is the PE ratio. So it's a ratio of the market value of a share to the annual earnings per share. For every company whose shares are traded on the stock market, there is a PE ratio. So for private companies, a suitable PE ratio can be selected and used. So the value will be the earnings per share, EPS, times the estimated PE ratio. EPS being the prior year EPS, an average EPS for prior years, or a forecast EPS. PE ratio is based on the average PE ratio of similar listed companies. So look at an example. The EPS of a private company, ABC company, was 15 cedis last year and is expected to rise to 18 cedis next year. Similar companies whose shares are quoted on a stock market have PE ratios ranging from 10 to 15.6. The average PE ratio of these companies is 12.5. Find the value of a share. So using the PE ratio method, we are saying that the valuation will be equal to the 18 cedi, which is the earnings per share, multiplied by 12.5, being the P ratio of the average P ratio of similar companies. 12.5 to give you 225 per share. However, in using the P ratio, we could also consider using any amount within the range. That's 10 to 15. You could use 12, you could use 13. But often, where the company is not listed, then you would want to reduce the PE ratio so that you make room for any risk that may arise. So we go to the earning yield method. But before we go on, we need to know that the PE ratio is not objective or scientific valuation method and is based on accounting measures such as EPS, earning per share, and not the cash flow. However, it is commonly used for IPO of private company and takeover bids. The main advantage is that the PE ratio method is quite simple. So earning yield method, valuation is based on the annual earnings and a suitable earnings yield. So the current market price of the share will be equal to the earnings per share divided by the earnings yield. So the earnings yield may be higher than that of similar quoted companies to allow for higher risk. So if you remember, I mentioned that the PE ratio may be lower for similar companies to make room for any higher risk. Okay. So earnings yield is often higher due to the risk that we anticipate. So this is essentially a variation of the PE ratio method and subject to the same criticism. So we look at an example. The earnings of Kickstart, a private company, were 450,000 last year. Stock market companies in the same industry provide an earnings yield of about 9% of their shareholders. Using the earnings yield method of valuation, suggest a suitable valuation for the equity shares in Kickstart. So we see that the earnings is 450,000, 9% being the earnings yield of companies in the same industry. So our valuation will be 450,000 divided by the earnings yield of 9% to give us 5 million being the value of the equity share. Or we could say we want to make to allow room for higher risk, we could say let's assume the earnings yield to be 10%, and that would also help us in arriving at the value. So we continue with certain other income-based valuation methods. We have the dividend yield. The company shares are valued using its dividend for the year and a suitable dividend yield. So the current market price per share will be the dividend per share divided by the dividend yield. And the dividend yield is higher for similar quoted companies to allow for risk of investment in private companies. And this is used to value small shareholdings where the shareholders may have little say in the running of the business and is interested only in the income stream that it provides. So other dividend valuation models, we have the constant annual dividend. So it's more objective and cash-based approach to the valuation of the shares. It's an income-based approach, but based on expected future dividends rather than on total earnings. The assumption is that the value to shareholders is the value of all future dividends expected. All expected future dividends in perpetuity are discounted to a present value at the cost of equity capital. Hence, constant annual dividend is assumed every year into the foreseeable future. So the market value MV is equal to D1 over RE, where RE is the shareholders' required rate of return. D1 is the expected future annual dividend, which starts at 1, and MV being the share price X dividend. This valuation model assumes that the dividend is paid annually and the current year's dividend has just been paid. For an exact valuation using this model, it should be assumed the next dividend is payable in 1 year's time. If annual dividend in the current year has not yet been paid, but will soon be paid, the value of the share is its cum dividend. You might be asked to suggest a cum dividend valuation where an annual dividend will be paid in the near future. If so, you should assume that the X dividend to arrive at a cum dividend valuation. So we'll look at an example. A company is expected to pay an annual dividend of 48 cedis per share into the foreseeable future, and the shareholders' cost of capital is 12%. The most recent annual dividend has just been paid. So we are required to use the dividend valuation model to suggest what the value of the shares will be. So using the dividend valuation model, we have an annual dividend of 48, and then the dividend, the cost of capital for shareholders is 12%. So simply we have 48 divided by 12% to give us 400 being the value of the share. The second one is show how the valuation will change if the expected annual dividend in future years is 54. So then we use 54 divided by the 12% to give us 450 being the value. Then C, we should show how the valuation will change if the expected annual dividend in future years is 48, but the cost of equity capital is 12.5. So same 48 divided by 12.5 to give us 384 cedis for the value of the share under the constant annual dividend model. So the dividend model therefore provides an explanation of how the value of the shares will rise or fall when there are changes in either the expected annual dividend or shareholders' required rate of capital. That's the equity cost of capital. Okay, so what if there is a growth rate? There is a constant rate of growth in the annual dividend. What do we do? So an alternative assumption in the dividend valuation model is that the annual dividend will grow in the future. A simplifying assumption is that the dividend will grow at a constant annual percentage rate. So with this, the market value is D into bracket 1 plus G divided by RE minus G, where RE is the cost of equity, D is the annual dividend for the year that has just ended, G is the expected annual growth rate expressed as a proportion. Therefore, D1 plus G is equal to the expected annual dividend next year, or D1, MV being the share price, X dividend. So this is the valuation of the share, X dividend, and based on the assumption that the dividend is paid annually, and the dividend for the current year has just been paid. So we look at an example. A company has just paid an annual dividend of 48 cedis. Dividends are expected to grow by 4% each year into the foreseeable future. The shareholders' cost of capital is 12%. So using the formula, 48 becomes our dividend that was paid, and we expect it to grow by 4%. So 48, 1 plus 0.04 divided by the cost of capital, which is 12% minus 0.04. to give us 624 cedis, being the market value where there is a constant rate of growth in our dividend. And we'll look at another example. So, however, the valuation of the share changes with the changes in expected future dividend and the changes in the required rate of return, as we saw in the previous scenario as well. So I will look at another example. The share price of ABC company is currently 400 cedis. The cost of equity capital is 12%. Annual dividend has just been paid. It's expected that the annual dividend next year will be 20 cedis per share, and the annual dividend will grow at a constant annual rate into the foreseeable future. So we are required to calculate the expected annual growth rate in dividend from next year onwards. So this is a matter of change of subject. We've been given the market value, which is 400. We've been given the dividend that's been paid. That's the 20 cedis. Dividend next year is 20 cedis. And then the cost of capital, we also know, which is the 12%, but we don't know the G. So how do we find the G? So 400 being equal to 20 over 0.12 minus our G. Our G, then when we do change of subjects, is 7%. So that's our growth rate. So suppose that the stock market now receives new and unexpected information about the company. That makes investors reassess the future annual dividend. Investors now expect that the annual dividend next year will be 10% lower than the previously expected, and that annual growth in dividend in subsequent years will only be 4%. So we are supposed to calculate the price that should now be expected for shares in ABC company. So with this, we know the market value is what we are looking for. Our dividend now, according to information we are receiving, is that it's 10% lower. We were expecting 20, but 10% lower. So now it's going to stand at 20 minus 2. That's 18. And then our cost of equity capital is still 12%, and our growth rate is also 4. So with this information, we are getting a market value of 22.5 Ghana cedis. So we move to retain earnings. So dividend growth can be achieved by retaining some profits or retain earnings for reinvestment in the business. Reinvested earnings should provide extra profits in the future so that the higher dividend can be paid. When a company retains a proportion of its earnings each year, the expected annual future growth rate in dividend can be estimated using the Gordon's growth model. So with the Gordon's growth model, G is equal to BR, where G is the annual growth rate in dividends in perpetuity, B being the proportion of earnings retained for reinvestment in the business, and R being the rate of return that the company will make to its investment. So we take an example. A company has just achieved an annual earnings per share of 50 cedis, of which 40% has been paid in dividends and 60% has been reinvested as earnings. The expected return on investment is 10%. So with this, per the Gordon's growth model, our annual growth rate in dividends in perpetuity will be equal to 60% multiplied by 10%, where 60% is a proportion of earnings retained, and then 10% being the expected rate of return. So it will give us 6% being the annual growth rate in dividends in perpetuity. We'll move to valuation of debt and preference shares. So valuation of debt securities, the value of debt security or bond is the present value of all future interest payments and the repayment of the debt principal, discounted at the pre-tax cost of debt. This valuation model for bonds is more exact than the dividend valuation model for shares. For fixed rate bonds, the present value of all future interest payments and the repayment of the debt principal is therefore calculated using the discounted cash flow to obtain a present value of future cash flows from the bond. Here we are calculating the market value of a bond from the future cash flows from the bond and the before tax cost of capital. So valuation of irredeemable fixed rate debt. So this is fixed rate debt. This is a fixed rate debt and the present value of interest payments in perpetuity. The valuation model for irredeemable debt is similar to the dividend valuation model with constant annual dividend. So the market value of debt using the lender's required rate of return will be MV is equal to I over RD. And the MV of market value of debt using the borrower's cost is equal to I into bracket 1 minus T and the post-tax RD, where RD is the cost of debt capital, I being the annual interest payable, T being the rate of tax on company profits, MV is the ex-interest market value of the debt. Note that the calculations are usually performed on a nominal amount of 100 or 1,000. So we take an example, a 7% bond denominated in euros pays interest annually. The interest yield required by the bond investors is 8%. So what is the market value of this bond? So as we said, the nominal is 100. So 100 times 7% being our I divided by 8% being the interest yield or the cost of debt that we are expecting. And it will give us 87.5 being the market value of the bond. So what if we have redeemable fixed rate debt? So this is the present value of all future interest payment on the bond to maturity, plus the present value of the principal repayment at maturity, discounted at the interest yield on the bond. So that would then give us the valuation of redeemable fixed rate debts. We go to valuation of convertible bonds. So the market value of a convertible bond is the higher of the value of the bond as a straight bond that will be redeemed at maturity, and the present value of future interest payments up to the time that the bonds can be converted into shares, plus the present value of the expected market value of the shares into which the bonds can be converted. So we are looking at two instances where it's going to be a straight bond and where at the time of maturity we are converting it into shares. A convertible should therefore be valued by each of these methods, and its value will be the higher of these two valuations. So we look at an example. A company has issued some 4% CD-denominated convertible bonds. These are convertible into shares of the company in 4 years' time at the rate of 25 shares for every 1,000 bonds. Interest on the bond is payable annually. Interest on the bond is payable annually, and the current year interest has just been paid. The current market price of the company shares is 46, and the shareholders expect annual dividends to grow by 5% per year into the foreseeable future. The dividend is paid annually, and the dividend for the current year has just been paid. The convertible bond holders require an annual return of 6% per year on their investment. What is the current price of the convertible bond likely to be? So as we are aware, we need to find first the value of the bond as a straight bond to be redeemed at maturity, and the present value of future interest payments where the bond is going to be converted into shares. So the current price of the convertible bond will be the higher of the value of the bond as a straight redeemable bond, redeemable in 4 years' time, and the value of a bond that will be converted into shares in 4 years' time. The current share price is 46 cedis. As we've seen in the scenario, the fourth line, the current market price of the company share is 46. So the current share price is 46, but where dividends are expected to rise, dividend to grow by 5% into the foreseeable future, then we are saying that 5% will also be the rate applicable for the price of the share, the share's price growth. So 46 times, using the simple future value, present value formula, we'll have 46 times 1.05 raised to the power 4 to give you 55.9 being the expected share price in 4 years' time. So we now go to the first instance where it's going to be redeemed at maturity. We know that the interest we are expecting is 4%, and the bonds and the nominal is 1,000. In this situation, we've been given that second line, rate of 25 shares for every 1,000 bonds. So the nominal is 1,000. So 4% of the 1,000 nominal amount is 40. So 40 then becomes our interest. So using the annuity, we find the 40 annuity present value, which is at a discount factor of 6%. So that will give us 3.465. So 40 times our 3.465, giving us a present value of 138.6. And then our redemption value, when we are redeeming it, so 1,000 cedis being the nominal amount of the bond, and our discount at 6% at the end of 4 years is 0.792. So our total present value of the bond as a straight bond, that's the first instance being redeemed at maturity, is 930.6. Then we also consider the scenario where the value of the bond, if the shares are converted. So our interest remains 40 and a present value of 138.6. But in this situation, we look at if it's going to be converted into shares, what is the value of the share at the end of that 4 years period. So we got 55.9 being the expected share price in 4 years' time. And there are 25 shares. So that's going to be 25 shares for every 1,000 bonds. So that's going to be 25 times the 55.9. So 1397.5, and being discounted, we have 1,106.8. So a summation when the bond is going to be converted is 1,245.4, and then per our valuation of convertible bonds is the higher of. So then the convertible bonds will have a current price of 1,245.4. So that is what we'll be getting when we are valuing the convertible bonds. 1,245.4. So I would like to thank you very much for staying with me to this point. Kindly follow the link below to join the Telegram channel for paper 2.4, financial management. You have access to the slides and also the marking scheme for the examples discussed in this question. Thank you very much, and I hope to see you in the next session. Bye-bye.